Thank you, Tracy. Yes, so I'm going to talk through the change of basis period for income tax. So this is quite a big change that HMRC are introducing and will come into effect from April 2024. What this basically means is any business with a year end other than the 31st of March or 5th of April will be taxed on their earnings to the end of the tax year of 5th of April on an annual basis. At the moment, businesses with year ends that don't coincide with the 5th of April or 31st of March are taxed in the tax year in which their profits fall. So for a business with the 30th of June 2022 year end, this will form part of their partnership or business tax returns for the year to the 5th of April 2023. Effectively, what HMRC are bringing in for the current year for 2023-24 is a transitional year, which will allow businesses to switch from their current accounting period to the new income for business tax year rules. Effectively, this will allow businesses to align their year end to the 31st of March or 5th of April if they currently do not have a year end of either of those dates. In this transitional year, effectively, any business with a non-5th of April year end will be taxed on their normal 12 months worth of profits to current account year end, plus a proportion of profits running from the first day after their current year end all the way through to the 5th of April 2024. These profits arising in the second period will be called transitional profits, and transitional profits can then be spread over a 5-year period, and this will need to be looked at on an individual basis as to whether spreading the tax over a 5-year period is beneficial to individuals. Effectively, this means that in the year to the 5th of April 2024, which is the transitional year, taxpayers will need to bring additional profits into their tax returns over and above what they would normally do, because they will be being taxed on an extended period. To help mitigate this additional tax burden, in addition to being able to spread the transitional profits over a 5-year period, taxpayers that have got overlap profits which have been built up when they initially joined partnerships or started in business will be able to deduct these transitional profits from the additional profits to reduce the transitional profits being taxed. Any of the remaining transitional profits can then be spread over a 5-year period, although taxpayers can elect to be taxed on them sooner if circumstances permit. This will have an impact upon the loss of the tax-free personal allowance. So for any individuals whose earnings are up and around £100,000, consideration of spreading the profits over a 5-year period would need to be looked at and numbers be crunched to see with the impact. It will also have an effect on the payments on accounts that are calculated as becoming payable in January and July of each year and class 4 national insurance. HMRC have announced that for any individuals that will be looking to align their business year with the tax year, there will be no impact upon the calculation for the income for the high income child benefit charge, and the income used to calculate pensions tapering will not be affected by the transitional profits. So where that gets us to at the moment is any business with a non-31st March or 5th of April year end would be required to apportion profits from 2 different sets of accounts if they decide not to change their accounts year end. Effectively, this would potentially mean that for any businesses with a 30th of September year end, for example, the accounts may not be finalised in time for the tax returns being submitted at the end of January. So estimated figures would need to be submitted on a partnership tax return and individuals' tax returns, and then corrected at a later date when the final figures are known. HMRC have confirmed where estimates are submitted, interest will be applied for any underpayment of tax. So consideration needs to be made by businesses on an individual basis as to whether they change their year end or not. By bringing in the income tax for basis periods, HMRC are effectively accelerating the time span between profits being calculated in sets of accounts and becoming payable. So profits from a business with a 31st of March year end would be payable by the 31st of January in the following year, which is a period of 10 months. Currently, businesses that have a 30th of April year end pay the tax on these profits in the January 2 years after they've arisen. So that's a period of 22 months. Under the new scheme, that period would be brought down to a period of 9 months if a 30th of April year end is continued to be used. So the options available, businesses could elect to look at changing their year end so that it coincides with the 31st of March or the 5th of April. And that is a consideration for any business with a year end from July through to February. Effectively, the accounts from a July year end through to a February year end may not be prepared or finalised in time to provide accurate figures to HM Revenue and Customs, and estimates would be being used. If businesses do not elect to change their year end, effectively a 30th of April year end would have 11/12 of their profits from one account year and 1/12 of the accounts from a second account year being assessed on one partnership tax return. So there would be additional calculations being undertaken in the background to derive the figures that would be reported on tax returns. Any business with a year end from April through to June could potentially remain as year ends as have historically been, as it is most likely that these sets of accounts would be finalised in time to apportion profits from two different accounts years to be reported on partnership tax returns. Effectively, any business with a non-March year end at the moment can undertake relatively accurate tax projections for liabilities arising in the next 2 years. Effectively, HMRC changing the way that tax periods are based does make this a bit more difficult. If businesses change their year end to the 31st of March, hypothetical figures would be being used for future tax periods. The change of basis period for income tax has been implemented in advance of the Making Tax Digital for income tax, which will come into effect from April 2026 and affect self-employed individuals and partnerships. So this is the first phase of the revenues overhaul of the tax system, which will be followed up in a couple of years' time by the Making Tax Digital rules being implemented. For partnerships, the enrolment date for Making Tax Digital has not yet been confirmed, but it is likely that it will be within a 2-year period after the self-assessment overhaul of Making Tax Digital. So I did want to run through some additional points in regards to PFP insurance. So Lentils offer a income tax investigation insurance through a third party called PFP Insurance. Due to the annual allowance charges being reported on individuals' tax returns for pension annual allowance changes and growth rules recently, we are seeing a number of additional inquiries from HMRC due to how the annual allowance charges have been reported on self-assessment tax returns. And if scheme pays elections are being used for the NHS pension schemes to pay the additional tax liabilities arising, HMRC are opening up a number of inquiries, which is in addition to the standard inquiries that we would see in a normal year. We are seeing an increasing number of inquiries, and in most cases it is a relatively simple check from HMRC to confirm the figures are actually correct and have been substantiated. But there is potential that these checks could lead to a full tax investigation if HMRC are not satisfied with the information being provided, which could then lead to significant legal costs for the taxpayer. The PFP insurance does cover tax investigations and is an additional option that we do provide to clients when we sign them up. And the PFP insurance does cover the majority of the costs for a full tax investigation. For the insurance cover provided, the price is actually relatively inexpensive. So I've set out on the slide the various premiums, which run from £102 upwards. And most businesses that we act for fall within those two price brackets quoted. Any business with a turnover in excess of 5 million would need to go independently to PFP Insurance Services to obtain a quote for their cover. So the PFP insurance does cover business insurance, which covers sole traders, directors of a limited company, partners in a partnership, and their spouses of the business where lentils prepare the personal tax returns. A separate business policy is required where rental income of more than £50,000 per annum is received and declared on a tax return. So for the price the PFP charge, I personally believe it is a relatively good insurance scheme. Like all insurance, it is something that you take out that you may not need, but on the times that it is required, it is absolutely invaluable for the price that's being paid. As a disclaimer, lentils do receive a commission from PFP for introduction of clients to their insurance scheme, and the amount of commission that lentils receive is disclosed on the PFP insurance documentation that we send out to clients.